The most stable bond market on the planet has silently collapsed. $7 trillion and $300 billion have begun to move, without warning, without headlines, without public reaction. In 18 hours, yields exploded 25 basis points. It sounds technical, but here's the detail that almost nobody understood. This broke one of the most rigid markets in the world. And while everyone is looking to the United States or China, it is Japan that may have just pulled the first domino in an unprecedented global crisis. By the end of this video, you'll clearly see the pattern that's repeating itself, and what really comes after a financial earthquake like this. Most people will realize it too late. Those who understand now will have a head start. Few people realized it, but what happened in Japan wasn't just another market fluctuation. It was an unprecedented disruption in 4 decades. Early on January 13th, the Japanese long-term sovereign bond surged 25 basis points. That alone would be alarming. But the detail that almost no one understood is that this type of bond almost never moves. It's as if a marble stone trembled. This movement was enough to cause losses in the billions in less than 18 hours. We're talking about a market worth $7 trillion and $300 billion. And the most frightening thing? All of this started because of a single political decision made during a seemingly ordinary morning in Tokyo. The most solid stability on the planet was broken silently. Most global investors still believe that Japan is a financial stronghold. After all, it's the world's largest creditor, isn't it? But this perception has been out of touch with reality for a long time. What happened now was just the trigger. And the most intriguing thing is this type of movement doesn't go back to square one. It's not a correction. It's a phase change. This market shock signals something that the big players have already understood. Confidence has been shattered. And when confidence disappears, the numbers stop obeying. This is not an exaggeration. It's exactly what has happened before in cycles of monetary collapse. The difference is that this time it started with the country that everyone thought was the safest. And that's where things start to get more dangerous. Because when a market considered inviolable cracks, all the others tremble. This movement won't stop in Japan. It will spread. And the contagion has already begun. It didn't take 24 hours for the effects of the Japanese earthquake to begin appearing on other continents. The first signs were subtle. A slight increase in yields on 30-year U.S. Treasury bonds, followed by a sharp drop in European pension funds. To the general public, nothing seemed out of the ordinary. But for those who understand the global map of capital flows, it became clear the contagion had begun. And what makes this so dangerous is the interconnectedness. Norwegian pension funds, Asian central banks, German insurers, all with billions invested in long-term Japanese bonds. They weren't prepared for this disruption. And when Japan breaks a pattern, they need to unwind positions to cover losses. This generates a silent but relentless chain reaction. And here's the point that almost no one realizes. It's not just the countries that are interconnected. It's the system. A sudden movement in Japanese income can force asset liquidations in Australia, margin adjustments in U.S. funds, and emergency reallocations in Swiss banks. Does that sound like an exaggeration? It's not. It's global portfolio mathematics. This is where everything starts to spread. This contamination doesn't make headlines. It happens behind the scenes at the big trading desks. It happens in emergency meetings of risk committees, in silent calls between central bank CEOs. The tension hasn't yet reached the masses, but behind the scenes, things are already on high alert. And whoever understands this now is playing with insider information. Japan is not the final epicenter. It's the crack that starts the fissure. And when the fissure begins, it's impossible to predict which pillar will be the next to give way. What we do know is that the most leveraged markets, like those in the United States, are exposed. And fragility now is not a question of if, but of when. When the first reports began circulating behind the scenes, one number appeared more frequently than any other: $4 trillion. That's the conservative estimate of how much could be forced into liquidation if confidence in Japanese bonds continues to fall. This is not speculation. These are calculations based on cross-exposure, leverage, and cascading effects in derivatives. But here's the detail that almost no one notices. Japan isn't the problem. It's the architecture of the global system. Japan merely lit the fuse. The real bomb is the volume of money that depends on the stability of sovereign bonds to keep circulating. And when that foundation disappears, liquidation isn't a choice. It's a mandatory reaction. Managers around the world are revising their risk models. They know that when an asset considered risk-free starts to fluctuate like a tech stock in crisis, the only possible defensive move is to sell. Sell fast. Sell before the next person starts selling. This turns a normal repricing into a downward spiral, a race to the door. What makes this uncontrollable is the speed. In leveraged financial systems, each sale forces others. Each reallocation generates collateral losses. And as funds reposition themselves, the domino effect spreads to stocks, currencies, private credit. A fall in bonds can turn into a liquidity crisis in a matter of days. And that's exactly what central banks are trying to hide. But it's too late. The system has reached a stage where decisions no longer matter as much as the chain reactions they trigger. It's not a crisis of perception, it's a crisis of position. And what's most unsettling is that this has happened before. History shows that once started, this process doesn't reverse. It only accelerates. In the midst of one of the most delicate phases of the Japanese economy, the Prime Minister made an unexpected decision. She called for early elections. But the real shock came with the speech she gave immediately afterward. On national television, she promised to suspend food taxes and increase spending on social programs, all without presenting a single clear source of funding. It was like pouring gasoline on already unstable ground. The market reaction was immediate, not because of the content of the promises themselves, but because of the implicit signal. The Japanese government is no longer concerned with fiscal discipline. On and when the country's highest authority ignores debt sustainability, the market interprets it as a red alert. Confidence, which was already cracked, began to crumble. The detail that few noticed is that this early election was not a strategy. It was political desperation disguised as a popular initiative. With its support base weakened and internal pressure mounting, the government needed an optimistic narrative. It chose to promise immediate relief, completely ignoring the medium-term fiscal consequences. And that's precisely where everything starts to get out of control. Because when more spending is promised without indicating where the money will come from, the market automatically assumes it will come from printing money. And every time that happens, institutional investors make the same move. They exit, they sell, they reallocate to assets considered safer, usually outside the country. This sequence of events is nothing new. It's exactly what happened in the pound-sterling crisis of 1992, the collapse of the Argentine peso in 2001, and dozens of fiscal collapses throughout the century. The difference is that now we're talking about Japan, the world's third largest economy, and when a superpower throws out the manual of fiscal responsibility, the whole world trembles. 237%. That's the size of Japan's public debt relative to its gross domestic product. For every $10 the Japanese economy generates, it owes almost 24. No other developed country has reached this financial abyss, not even the United States, which is already at levels considered unsustainable with 125%. But the detail that almost no one realizes is that Japan didn't get there by accident. It got there by choice. It was decades of fiscal stimulus, bailout packages, money printing, and promises that this time it would be different. But the cost of that illusion has arrived, and it won't be paid in easy installments. It comes in the form of disruption. The difference between Japan and other indebted countries is that, for a long time, confidence sustained everything. The Japanese themselves bought government bonds. The central bank absorbed a huge portion of the debt. This created the illusion of stability. But like any castle built on sand, eventually the tide comes in, and now it has arrived. Buyers are hesitating. Interest rates are rising. The world is beginning to question something that for years was treated as unquestionable. Can Japan still afford to pay for all of this? The question is frightening because if the answer is no, or if the market at least begins to doubt it, the spiral of destruction accelerates quickly. From this point on, the discussion ceases to be about economics and becomes about the survival of the system. Because if the most disciplined country in the world, with the highest savings rate in modern history, can no longer sustain its own debt, who can? Japan is no exception. It is a reflection of what is to come. In a single day, Japanese 40-year bonds saw a 25 basis point increase in yields. To the average investor, this number may seem technical, but for those who understand how sovereign debt markets work, this movement is a veritable cry of revolt. It's as if a freight train derailed on a flat stretch of road. This type of security is the most predictable in the financial system. It represents long-term confidence. And confidence, as we know, is the oxygen of the market. When it disappears, everything stops. The abrupt rise in yields was not just an adjustment, it was a violent, almost visceral reaction to a scenario that had become unsustainable. And the detail that almost no one understood is that this type of movement never happens in isolation. It's always a response to something bigger. Institutional funds, which hold hundreds of billions in Japanese bonds, have begun to repricing the risk. And this doesn't happen out of emotion. It happens because the numbers stopped adding up. The 25 basis point increase represents billions in instant losses for those who were positioned in these securities. Hedge funds, pension funds, central banks, everyone felt the impact. And as with any collapse at the start, nobody wants to be the last one out. The panic isn't yet visible in the headlines, but behind the scenes, the sell-off has already begun. That's why experienced analysts are using a term that seemed exaggerated weeks ago, financial earthquake. Because when a market that shouldn't move does move in this way, it doesn't return to its place on its own. It pulls everything around it down. And that's exactly what's about to happen to the global system. 40-year bonds are designed to be stable. They are used by pension funds, insurance companies, and central banks precisely because they hardly move. It takes months, sometimes years, for such a bond to rise 10 basis points. But now, in less than 24 hours, we've seen a 25 basis point increase. This isn't volatility, this is dysfunction. And this is where the gravity of the moment becomes apparent. What is collapsing is not just an asset, but the perception of security built up over decades. Japan was seen as the last bastion of monetary stability, a country with fiscal discipline, a culture of saving and control over its currency. If even this market is now breaking down, what is left? The detail that almost no one notices is this. Large investors don't wait for public explanations to act. They anticipate the collapse. When the numbers start moving outside the expected range, it's not just statistics. It's a sign that confidence has ended. And when confidence ends, liquidity evaporates. This type of movement doesn't happen in healthy markets. It indicates a system pushed to its limit, a system where buyers no longer believe in the issuer's ability to honor its obligations. And this loss of faith, once established, is almost impossible to reverse, even more so when the issuer is a sovereign state with debt exceeding 200% of GDP. And what's most alarming, this isn't an isolated collapse. It's a symptom of something bigger, deeper, a sign that the cycle has shifted. The debt markets are no longer pricing in risk. They're fleeing from it. And when capital starts fleeing, no amount of political discourse or intervention can stop what comes next. Global financial history is marked by cycles, and in each collapse cycle, there's always a breaking point. A moment that seems isolated, but which in fact represents the first domino falling. Japan has just assumed this role. Not because it is fragile, but precisely because it was seen as unshakable. What we've just seen is no accident. It's the beginning of a sequence. Whenever a major economy loses control of its debt, the effect spreads. First through bonds, then currencies, then capital flows, and finally through confidence. And confidence, when it's gone, doesn't come back slowly. It vanishes in seconds. The detail that almost no one notices is that the world today is more interconnected than at any other time in history. Global funds, central banks, sovereign reserves, all depend on the stability of a few pillars, and one of them has already cracked. Japan is not the final collapse. It is the warning. It is the siren that sounds before the abyss. And here's the most important point. The collapse doesn't begin when the press announces it. It begins when capital flows reverse, when the big players quietly exit, and that is already happening. The sell-off has already begun. The liquidation is underway. Now it's just a matter of time before the next dominoes follow the same path. The question now is not whether there will be a global crisis, but what will be the next piece to fall. And when it falls, who will be positioned and who will be caught off guard? Because when the sequence begins, there's no way to pause it. The only way is to protect yourself from it. And the time to do that is running out. Everything you've seen so far is nothing new. It's the same pattern that repeated itself in 16th century Spain, pre-revolutionary France, Weimar Germany, the 1992 pound sterling crisis, and the Greek default in 2009. When confidence in debt ends, the system collapses. Always. The only difference is that this time, we're seeing it happen in real time, in one of the largest economies on the planet, and whoever understands this cycle now has an advantage. Because the next time a newspaper mentions temporary instability, you'll already know the domino has already fallen. But knowing isn't enough. The difference between those who watch the collapse and those who protect themselves from it lies in one word: positioning. And that positioning begins with information that almost no one is seeing. Now that you know, the choice is yours. If this content gave you clarity, click the subscribe button now, turn on notifications, and leave a like. This helps the channel and ensures you continue to receive future episodes of this series. In the next video, I'm going to show how central banks are trying to cover their tracks in this crisis, and why this could make the situation even worse.